right. Good afternoon, everyone. I hope lunch was good. Unlike Scott, my voice is also a little hoarse, but it's more karaoke-induced than illness-induced. It was a good time last night for those who joined. But I'm going to keep this introduction short because I don't think he needs a long one. So Michael Saylor is going to be taking over this next session, and he's the founder and executive chairman of Strategy, the world's first and largest Bitcoin treasury company, which now holds nearly 4% of Bitcoin in existence. So he's here to talk about digital credit, Bitcoin, and what it all means for the future of finance. So Michael, come on up.
Nice to see you today. Love my lights. I've got a set of slides to review digital capital, equity, and credit. I'll move through those as briskly as I can. Then I will make a few comments on the current market right now. The equity capital markets, the crypto markets are quite chaotic, as I'm sure many of you have noticed. And I'll give you my take on that. And then I'll take as many questions as I can from the audience. So thank you for your time today. So first I'll start with the big idea. There's equity capital, there's metallic capital, gold, there's credit or fiat capital like sovereign debt. The idea of digital capital is how does somebody in Russia or Ukraine or Iran or China or South America or Africa buy $1 billion of something that they put in cyberspace and move anywhere in the world? How do I move $1 billion between Tokyo and Abu Dhabi on a Saturday morning, right? How do I custody $1 billion in my hand, in my head? That's the idea of digital capital, pure economic energy created cryptographically. And of course, the solution that the market has come to over the course of about 15 years is Bitcoin is digital capital. And why is it digital capital? It is the one network, the dominant digital monetary network that the world, the rich, the powerful have settled upon as the standard for digital capital. And the way you know it is the US government has embraced it. The president, the vice president, the head of the Fed, the head of the Treasury, all the other major cabinet members. This is a major sea change starting in 2024 that is. Capitol Hill has embraced it. You can see it in the legislation that's moving through Congress right now. You can see the major banks have embraced it, Morgan Stanley, Citi, TD. We keep track of this. 4 years ago, this was unthinkable. Now it's commonplace. If you look at the headlines, most major banks are moving to custody to extend credit, to trade, to transact in this asset. This is the formation of a new asset class, a commodity asset class, the world's first real legitimate digital commodity. We track global bank adoption and we try to keep track of, these are the top 15 banks. Do they issue credit against Bitcoin? Do they trade it? Do they trade the derivatives? Will they custody it for you? And you can see the status right now. 2 years ago, you couldn't have gotten a loan against either BTC or a derivative like IBIT. Now, there's probably about 10 major banks in the United States that'll give you a loan at SOFR plus 50 basis points to 100 basis points against IBIT. Off the top of my head, I could think Wells Fargo, JP Morgan, Merrill, Texas Capital Bank. I've listed a bunch. Citi, Schwab is very well known for that. And so this is going to continue. If you look at the reach of digital capital, we've now got 840 million crypto native accounts. You've got distribution to 980 million accounts with neobanks and almost 1 billion accounts through traditional brokerages. There were no ETFs on this digital asset two and a half years ago. Now there's 125. They hold $100 billion plus of capital. We got into this space in 2020. We were the first major public company to acquire digital asset or digital capital, in this case, Bitcoin. Now there's about 200 public companies. And so you can see the adoption has accelerated. So the basis of the entire industry, all of the crypto industry, all of the digital assets industry, it starts with a digital commodity, an asset without an issuer, BTC. And then everything is built on top of it, and there are a lot of things you can build on it. The thing that we've inadvertently built is digital equity. We created a company that holds digital capital, and when you have a company that holds digital capital, the equity of that company starts to also inherit those characteristics. So Strategy is the world's largest holder of digital capital. We have about 4% of all the Bitcoin that will ever exist, 843,000 Bitcoin to be exact. We've got a $53 billion market cap as of a couple days ago. We have issued $10.5 billion of STRC, of Treasury credit. That is the largest preferred stock in the world right now. It's been incredibly successful and the fastest growing. And this year we raised nearly $14 billion so far. This is a look at our journey. We started by buying a bit, $250 million of Bitcoin, and then we found that we were an institutional gateway for acquisition of Bitcoin. We had extraordinary support from equity investors, derivative investors, options traders, debt investors, convertible bond investors, and now preferred stock investors. And the result is we've raised about $64 billion of capital. We have built consistently every quarter more digital capital on our balance sheet. Today we have about $75 billion enterprise value, about $60 billion in reserves. You can see that we have about $6 billion of debt. It's convertible debt, effectively like 40 basis point interest rate. But that's the liability part of the balance sheet. We have a mezzanine equity, about $15 billion of preferred equity that we use for amplification. It's not debt. It doesn't come due. It's a hybrid instrument. It is a credit instrument, not a debt instrument. And of course, that creates leverage for the equity instrument. I'll talk about more on that subject in a second. A lot of people have this idea that somehow we're heavily levered, but the truth is we've got a 10% net leverage ratio. That's 1/10 of every bank that you know of. It's very small. It's like, again, $1 of debt for $10 of assets. We've got about $54 billion of equity capital. That's up by a factor of 100 in 5 years. It's been very rapidly growing. It'll keep growing, I think. We've got $10 of capital for our equity for our assets for every $1 of debt. You can see that. We call that a BTC rating of 10. You can see the net debt on the balance sheet right now after you subtract the cash. And now we'll get to the most important chart probably. This is a look at the capital markets for the past 6 years. So if we go back to when we started our journey in the summer of 2020, and you look at the performance of various capital assets, the S&P is equity capital. It's up 15% a year on average. Gold is metallic capital. It's up 15% a year on average. The Mag 7 stocks are all digital monopolies. They've outperformed the S&P. Not surprising. They're up 27%. Real estate's up 6% a year. It's been fairly slow capital. Money markets and short-dated treasury instruments, 3% a year. Bonds have been the weakest capital performer. They're down 4%, so investing in sovereign debt, long-dated corporate bonds or long-dated sovereign debt wouldn't have been a very good idea for the last 6 years. It's the dog in this chart, minus 4% a year. Digital capital has outperformed all of those things. That digital capital is Bitcoin. It's up 36% a year on average every year for 6 years. And our company has amplified Bitcoin. We have borrowed or issued credit instruments in order to accrete Bitcoin per share, and therefore we have outperformed Bitcoin. We're up 54% a year. What do I mean by accreting Bitcoin per share? Well, you know, you've got a share of stock. A year ago, we had 181,000 Satoshis per share. A Bitcoin subdivides into 100 million Satoshis, so Satoshi is like 100 millionth a unit, like a cent in the Bitcoin parlance. We've gone from 181,000 Satoshis a share to 220,000 Satoshis a share over the past year or so. We keep track of that with the metric BTC yield. Yield is like, on a Bitcoin standard, it's kind of like the dividend yield, but what we're doing is we're accreting, in this case, about 39,000 Satoshis per share over the course of a year. So we had a yield of 22.8% in 2025. Year to date, we've had a 13% Bitcoin yield. So we have 13% more Bitcoin per share right now than we had on January 1st of this year. We keep track of gain. That is, what is the gain in overall Bitcoin without commensurate equity dilution? That gain last year was 101,000 Bitcoin. That gain this year is 87,000. It's like we're synthetically mining Bitcoin. You can calculate the dollar value of that. It works out to $8.9 billion in value last year, $6.5 billion this year. If you're on the Bitcoin standard, I'll say it this way. If you think that Bitcoin is comparable to the S&P index, if you think it will appreciate about 10% a year, then that Bitcoin dollar gain is comparable to net income for a Bitcoin company or a company on the Bitcoin standard. If you don't think Bitcoins are going to appreciate 10% a year, then you would be skeptical of this. If you thought it was going to depreciate, then you can't really think in Bitcoin terms. But if you're a Bitcoin believer and you think Bitcoin appreciates about 10% a year, then when you generate $6.5 billion of Bitcoin dollar gain, that's $6.5 billion of net income. And so that's important because it's not necessarily the case that you believe that or that the market believes that, but what I could say is that every single equity investor in MSTR believes that. If you're holding the common equity, you're a Bitcoin maximalist. You bought the equity because you want to outperform Bitcoin and you believe in Bitcoin. So you actually believe Bitcoin is a better capital asset than the S&P index. Therefore, these Bitcoin gain numbers matter to you. They're like your net income pro formas. So what does Bitcoin per share look like over the past 6 years? You can see we started with 56,000 Satoshis a share. We've added Bitcoin per share every year. You know, we've ground our way up to 83,000, 91,000, 158,000, 194,000, 220,000. The mission of the company is to create more Bitcoin per share. And we do that primarily through selling credit and then buying the Bitcoin, and we capture the arbitrage. We capture the difference between the cost of the credit and the return of the Bitcoin. We've accelerated this year. We've got a 13% yield. It's like a 13% dividend yield, as I said, for a Bitcoin believer. The overall objective of the company is double Bitcoin per share over 7 years. Right now, we're on a pace to do it much faster than that. If you're an investor in the capital markets and you could buy IBIT or buy MSTR, if you had the option to buy either, IBIT is just wrapped Bitcoin 1-for-1. And MSTR is amplified Bitcoin. The reason that you would prefer to buy MSTR is because you expect the Bitcoin per share to double over 7 years or less, and so you feel like you're getting more than Bitcoin. The reason you would buy IBIT is you want to buy a simple ETF that has a low fee, and you just want to ride the commodity and get 1-for-1 Bitcoin return. There are some investors, equity capital investors, that literally can't buy the ETF, but they can buy the operating company. Just like in gold, there are a lot of people that can't buy gold or gold ETFs, but they can buy gold miners. So there's a whole class of investors that will always prefer to buy operating companies. They're a Bitcoin maximalist that want 2x Bitcoin performance. They will prefer the operating company. But of course, if you like just straight on Bitcoin and you want to buy it in the IBIT wrapper or any other ETF, then that's a good idea. They're very complementary to each other. We were the largest equity issuer in 2025, and we are the largest equity issuer year to date so far. That's just about to change. It's part of what I'm going to say in the capital markets. You're about to see extraordinary equity issuance by SpaceX, Anthropic, OpenAI, et cetera, Google right now. And so there's a massive explosion in equity issuance probably coming the back half of this year. But generally, up until now, we have been the primary equity issuer, and we've been the largest common equity, but we've totally dominated in preferred equity. We were 33% of all preferred equity last year. We're 60% of preferred equity so far this year. That has gotten people's attention. What do we do? I mean, the business is not very complicated if you're a financial engineer. We're basically a securitized finance or a structured finance company. What we're doing is we're taking a raw commodity, Bitcoin, which has a natural return of 36% a year. It has a 1-year volatility of about 40% vol. And so we're taking that natural return and that natural vol, and we're stepping it down. We're stripping the volatility and the risk off the instrument with our credit, and then we're amplifying the performance and the volatility with our equity. So there are a lot of people that they don't want 40 vol, and they don't want 36% ARR. What they would prefer is 5 vol and 10 ARR. And there are other people that would actually prefer 70 or 80 vol and 60 ARR. And if you're the latter, you know who you are. It's like options traders love that. If you're buying, selling, trading call options, put options, if you're a levered equity player, you want the higher performance and the higher amplification. But on the other hand, Strike is a convertible preferred with a long duration, and it's got about a 19 vol on 30 days and pays 11% dividend yield, and it has a conversion right, so it's kind of a hybrid. Stride is a junior preferred instrument, long duration. It's got a 16 vol, and it pays 14% effective yield. Strife is a senior long duration credit instrument. Think of it as like a 10-year or 20-year Bitcoin bond. And it's got a lower vol, 9%, because it's senior in the capital structure, and it pays about 10% right now. And then Stretch, STRC, is a monthly variable rate preferred. It's like a T-bill, not quite, but it's got the lowest volatility, and it pays a different yield. So depending upon your duration and your volatility and what kind of investor you are, you might want one of those credit instruments rather than equity. Strategy is the world's most widely held Bitcoin proxy. We can trace to about 100 million plus beneficiaries, and that's because thousands of institutions hold our common stock, about 1 million individual retail accounts, and then thousands of ETFs. And so there are a lot of people that literally cannot buy the commodity. For example, when we adopted Bitcoin as a strategy in 2020, a lot of people in the UK had money locked up in retirement accounts, and they could buy an equity trading on NASDAQ, but they could not buy BTC. In fact, most people in the world, they still have these retirement accounts, and they can buy equities, but they can't necessarily buy a crypto commodity. And sometimes they were enjoined or prohibited from buying an ETF. For 4 years, there wasn't an ETF. And then even after there are ETFs, oftentimes there are rules on what pools of capital can invest. So we've been a beneficiary of the fact that we came public in 1998 on the NASDAQ. We're a well-known seasoned issuer, and you're able to buy us from any broker or dealer that handled NASDAQ stocks. That was a big advantage. The other big advantage is to be able to get credit or to trade the options right? So something where we have the deepest options interest or the deepest open interest in the options market. We have the most liquidity in the equity market, and we're most compatible with most forms of exchange distribution and broker dealers. So that was very helpful for us. We didn't start out thinking we're going to do that. It was just a serendipitous result of being first. So now I'd like to talk about digital credit. What is the big idea here? If Bitcoin is digital capital, and it's basically engineered by putting together some standard techniques. We use proof of work, public key cryptography, peer-to-peer networking, distributed timestamping. All of that stuff you can read about in the white paper. It's been talked about ad infinitum. We needed modern semiconductors, a modern internet, modern cryptography in order to create Bitcoin. But once we had all those things, it was going to happen, and it's been spreading around the world. Digital credit is just built on another set of things that have been around for 100 years. For example, we created digital credit by issuing a preferred stock. Preferred stocks have been around for 200-300 years. STRC is a preferred stock. We then used it to buy and backed it in a soft way with a digital commodity, BTC. So you have a listed digital capital instrument, you have a listed preferred equity instrument, and then we pair it with a listed equity instrument, MSTR. So 3 listed instruments that you can buy and trade on the NASDAQ or with BTC. You can trade it on 1,000 exchanges everywhere in the world. And then we put it together with the idea of a monthly variable dividend. Now, a preferred stock can be constructed to be anything. It can look like debt, it can look like equity, it can look like a hybrid. You can attach any terms you want to it. It's a fairly flexible container. It's been around for hundreds of years. It turns out that before we created STRC, no one in the modern era had ever thought to create a variable credit spread adjusted monthly, paying a monthly dividend. So what you have is fixed preferreds, where you pay a fixed rate and then the price floats. And then you have floaters, but the floaters have a fixed credit spread over SOFR. And so their price is also going to float. What we did was we created a variable credit spread. We could actually adjust the dividend rate to any number. I mean, we can't move it too quickly. There's a limit. We can only lower it by 25 basis points a month. And the floor is SOFR. But the idea was we'll pay you SOFR with a variable credit spread, and we're going to adjust the credit spread to get a dividend rate in order to get the instrument to trade at $100. And we want to strip the volatility off it. We're targeting a $100 price that's paying you monthly dividend. And that was the monthly variable dividend. And not a brilliant idea, an obvious idea, just no one ever had a reason to do it. Well, we paired that with an ATM. We had an equity ATM where you sell equity in the market. We thought, what if we created the same ATM for the credit instrument? Why is that important? Because when it hits 100, if we sell it at 100, we strip all of the volatility above $100. So we used a shelf registration ATM at the market instrument in order to strip the volatility from a credit instrument intentionally. Right? And that was a new thing. No one had ever thought to do that. And of course, we discovered that if you actually sell $1 billion of a credit instrument, buy $1 billion of a capital asset, let the capital asset appreciate, and then monetize an unrealized capital gain in order to pay a credit dividend, then the capital gain is tax deferred and the credit dividend becomes tax deferred. And so we created a return of capital, and so we inadvertently created maybe the most tax-efficient fixed income generator in the world. The idea is you can pay billions of dollars of dividends. They're all return of capital. And that wasn't something we were starting to do. We just inadvertently discovered that because of the model of a Bitcoin treasury company or digital treasury company with a digital capital asset with digital equity, with digital credit. So what is credit? What we're doing is we're transforming capital into credit. We're stripping the currency risk. We're reducing the economic risk. Instead of being 1-to-1 collateralized, you'll be 10-to-1 or 5-to-1 collateralized. So if Bitcoin fell 80%, you're still over collateralized, right? So we're reducing economic risk. We're compressing duration risk. Instead of holding Bitcoin for a decade to get 30% a year, you can buy this instrument and get paid next month a defined amount. So we're converting 120 months of duration into 1 month of duration. And then we're damping the volatility, and we're distilling a yield. The world's full of capital investors. That's like, I want to buy $1 million of real estate, hold it for 30 years. It's got no cash flows. And then there's credit investors, I just want to get paid $10,000 a month every month, right? And so the world wants both. We created the credit side. And the idea is give everybody double-digit returns and tax efficiency. Those are the things you get from equity. Wouldn't it be great if I got 11% and I didn't have to pay tax on it, and it was a credit instrument, and I also had low volatility capital preservation or principal protection of a credit. So we're putting together the best idea of credit with the best idea of equity into digital credit. Right? How does this compare to other things? Well, compare it to private credit or hedge funds or private equity. Digital credit's liquid, there's no fee, it's homogeneous. You can calculate the risk every 15 seconds. We actually publish the credit model, and you can plug in your assumptions, and you can go and see it update every 15 seconds. So it's very transparent, it's very accessible, and of course it's very scalable. If you compare this to, say, what goes on in the private credit market, if I want to create $10 billion of private credit, I got to go make $10 billion of loans to 100 different private companies. That's opaque. There's a lot of friction to it. It's hard to assess that risk. On the other end, it's illiquid. But because we're creating the credit on top of digital capital, Bitcoin's trading tens of billions of dollars a day, and so our credit starts trading, and our equity trades. And so we inadvertently created a new asset class, digital credit. And who would want it? Institutional investors want it, corporate treasuries want it, hybrid investors want it, crypto investors want it, retail investors want it. Preferred stock was in the doghouse for 50 years. No one really thought much about it, but we built the railroads with preferred stock. There was a time when 20 to 40% of all the capital in the world was raised by preferred stock structures. That's how the Industrial Revolution took place. Then it fell out of favor in the 20th century, and it's been out of favor. And now we're bringing it back, and we're using it to reestablish the core financing layer for digital money, digital equity, digital credit, et cetera. Now, what's the indicator that that's working? Well, couple of things. You might have noticed Google just announced they're bringing a $15 billion credit instrument, a preferred stock to market, just this week. Bitminer announced yesterday they're bringing a digital credit instrument to market. So preferred equity is becoming more interesting, and in the digital asset space, digital credit is becoming more interesting. I want to talk about the theory of digital credit because a lot of people don't understand it. It's asset-backed credit. It's not credit based upon the cash flows of a private company or a public company or a government or a piece of a mortgage, real estate, or commercial building. Those are all different types of credit. This is asset-backed credit. The idea is to create credit based upon a capital asset that you're holding in perpetuity to capture its capital gain. So if you look at those asset classes that I just showed you, you can see that the S&P index and gold are about 15% performers. Bitcoin's been doubling to tripling that. If you build credit on an asset, the simple idea is I expect real estate to go up 6% a year, so I'm going to issue a preferred stock that pays you 3%. And I'm going to use the capital gain of the real estate to actually finance the credit dividend. It's not complicated. It happens all the time in different forms. It's just real estate credit's not all that compelling. Well, that's a mortgage-backed security of sorts. You could do it with gold-backed credit. In fact, it was done hundreds of years. In fact, the entire sovereign debt market was gold-backed credit from the 17th century, the 18th century, the 19th century. It only fell out of favor when we went off the gold standard. But if you expect gold to go up 10% a year, you can pay a 5% dividend on a gold credit instrument. You don't see any public companies doing that today, but they could in theory. Now, you could buy a portfolio of S&P equity, expecting it to go up 12% a year and pay a 6% dividend. The reason you don't see a public company do that is because the Investment Company Act of 1940 made it illegal for an operating company to capitalize on a securities portfolio. So an operating company can only have 40% of its liquid treasury assets in securities. That caps out, say, a Berkshire Hathaway. That's why they can't allow their equity portfolios to grow past a certain level, and they have to sweep into treasuries or the like. By the way, technically, treasuries are securities, but there is a carve-out in the Investment Company Act of 1940. As you would guess, the government gave itself an advantage, and it disadvantaged everybody else's securities. So who does create equity-backed credit? JP Morgan, Morgan Stanley, Goldman Sachs, all of the big banks create structured finance products where they're basically stripping the downside risk, capping the upside, and giving you some kind of yield off it. And they're selling it to high net worth individuals. They do this in the form of private funds. They're expensive, they have high fees, they have short durations, they don't trade on the public market, but they've done it. And that's been their bailiwick because you can do this with a private fund. You cannot do it with a public security. One of the big unlocks is Bitcoin is a commodity, not a security. And because it's a commodity, a publicly traded company can buy $60 billion of Bitcoin. It can sell a preferred stock, and it can remit a dividend yield by monetizing the unrealized capital gain or the realized capital gain of that capital investment. And that's exactly what we do. So you see, if you look at digital capital, it's like a sine wave. There have been 5 brutal drawdowns of Bitcoin in the past 5 years. It surges, it crashes, it surges, it crashes, it surges, it crashes. You can go look at the chart. What we're doing is we're taking that signal and we're stripping the first 11.5%, and we're passing that through to the credit investor, and we're over-collateralizing it, say 4-to-1 or something. So we're stripping most of the economic risk, a lot of the volatility, and we're only passing through a portion of the performance. Where does the excess volatility and the excess performance go? It goes to the equity. There's a conservation of energy in the finance space. So if I'm going to capture a 30% and only pay 11, the remainder goes into the equity. And that's MSTR. So you see, what we've done is we've created a digital equity, amplified Bitcoin, and then we created a digital credit, STRC, and we're doing that with BTC as the underlying treasury asset. And because we're an operating company, we have a lot of tools at our disposal. We can sell the common equity, which is a BTC derivative, and that's very tax efficient. We can sell the BTC, especially highly appreciated BTC, and capture a tax credit. We can use cash, or we could even sell derivatives of BTC in the market, like perpetuals, and engage in the basis trade. And all of those things we use to generate the dividends. As long as we're thoughtful about how we do it, and we avoid generating excess earnings and profit in the period in question, all of those dividends become return of capital, which means that we pay you a $10 dividend, you reduce your basis in the instrument by $10. That means you can reasonably expect to collect 9 years of dividends without paying any tax. At the end of the 9th year, the $100 share has a basis of 0, and now it becomes QDI instrument, and you'll start paying long-term capital gains tax. This is an instrument where you could collect you could collect dividends for about 9 or 10 years and not pay tax on it. Then you could die, pass this to your heir. They get a step-up basis, and they collect dividends for another 10 years, don't pay tax on it. So for generational wealth transfer, it's a very interesting instrument. How's it performing? Well, we've gone from 0 to $10.5 billion in 10 months. It's the fastest growing credit instrument in the world, I think, right now. If you look at it, it's got $360 million a day of liquidity. We have issued $7.5 billion this year. The volatility right now is about 5.9%. It converts to a Sharpe ratio of about 1.37. It's $3.40 of Bitcoin collateral for every dollar of nominal outstanding. And we have about 35 years worth of dividends in our Bitcoin reserve. It's growing about 385% a year right now, so it's a hyper growth instrument. It's the largest tradable preferred stock in the world. So in less than 12 months, it went from nothing to bigger than Wells Fargo, Bank of America, Fannie Mae, everybody. And it's also the most liquid preferred stock in the world. Most preferreds don't have any liquidity. They're kind of dead money. And of course, because this is built on such a liquid capital asset and backed by a liquid equity, our equity is the most liquid crypto equity in the world. We trade $3 billion a day or more. We trade more than IBIT. And so very liquid equity, very deep open interest in the derivatives market. The underlying Bitcoin is very liquid. And so the credit has absorbed that liquidity. And also the turnover is very high. 3.4% of the entire market cap trading each day. That's like a 10x more intense turnover than a typical preferred stock. Now, why would you want to buy this? Well, on October 6th, Bitcoin was 125,000 a coin. And if you bought Bitcoin, you would have lost 43% of your money. And you would get no dividends. But if you bought STRC, you would be plus or minus 1-2%, and you've collected 7.4% in dividends. As of, I think, June 1st, you literally are at 0% loss. So you preserve your capital and you collect the dividend because the company strategy has this $70 billion or $80 billion enterprise, and we're using all of our tools to stabilize STRC at 100. What will we do? We'll raise the dividend rate. We did it 6 times or 5 times. We will raise billions of dollars of capital to buy Bitcoin. We will raise billions of dollars of capital in order to buy dollars to back it. And then we won't sell it if it trades a penny below 100 bucks. Like if you offered me $10 billion for a 1 penny discount to par, I wouldn't take the money. So we support it a lot of different ways. We refinance other debt, like we bought back $1.5 billion of our convertible debt above it. So the company is doing a lot of things to get this instrument to trade at 100. This is the flagship. And this is the journey from seasoning. The IPO was late July. It took a few months for us to get into the zone, and we moved into the zone all the way through May. The volatility's been falling. Why do you want to buy it? Well, because you're getting paid 11.5% on this instrument versus 3.5% on your money market. Why else? Well, because if you pay taxes in Miami, it's like a bank account that pays you 18.3%. The tax equivalent yield is off the charts. If you live in New York or San Francisco, it's like a tax equivalent yield of 22 to 24%. You can see what we're doing is we're creating the digital assets risk-free rate. This is the risk-free rate in the crypto economy, 11.5%, and then you can see the risk-free rate in all the fiat economies, and that's the arbitrage. Maybe I borrow money in yen and I buy STRC, or I borrow money in dollars and I buy STRC and I loop it. This is what it looks like for an individual in DC. It's like a bank that pays you 22%. In New York City, like a bank that pays you 24%. right? I mean, the tyranny is I have money that I need in 6 months. I'm getting paid 3.5%, and then the city, the state, and the federal government takes half of it. You know, so yeah, if you want complete risk-free or the normalized risk-free as you're going to get in the United States, you're going to put your money in a money market, but the price you're going to pay is the bank will either pay you nothing or you'll end up with 180 basis points after tax. If you believe that Bitcoin's not going to zero tomorrow, there are a lot of people that acknowledge digital capital, they just think the vol is too much to put their kids' tuition into it. So I need the money in the next year or 2 years, but I don't think Bitcoin's going to zero. I'm probably not going to buy the BTC. I'm definitely not going to buy the amplified BTC. But on the other hand, a digital credit instrument pays me 6 times the money market, and I'll let somebody else, I'll let the company's strategy absorb all the anxiety, all the risk, all the volatility, and manage this for me. So this is why it's compelling to a lot of people. The Sharpe ratio is off the charts compared to all other credit instruments. And we're running this to create the highest Sharpe ratio. You know, what's the return minus the risk-free rate divided by the vol, right? Everything we're doing is to strip the vol, you know, create synthetic yield, and provide you with a comfortable way to generate a return and a credit. And you can see the Sharpe ratio in a treasury bill is negative. It's just awful, atrocious. I mean, the only thing that's even close to respectable here is junk bonds, but they're not liquid, they're very opaque. If you compare the Sharpe ratio, clearly you would prefer to just take the SPY, which is giving you 1. It's paying you for the volatility you're accepting right now, but Stretch is outperforming the S&P. And gold Sharpe ratio is 0.39. You're getting a lot more vol than you're getting performance there. And you're getting a lot more performance than the vol for Stretch versus BTC as well. And you can see, like, if you buy V&Q, which is just a real estate ETF, you're getting a lot of volatility and awful performance. If you look at the Sharpe ratios in equities, well, NVIDIA is the champ right now. They're just killing it, but that's probably the greatest AI trade ever. But after that, Stretch is outperforming all the other Mag 7s. And so when you consider it to other types of assets or other types of credit, it's a very interesting mixture of performance, tax efficiency, and then Sharpe ratio and liquidity. Who's adopting it? Well, what you're seeing is all types of investors are adopting it. There's a huge retail following. We estimate 3 million beneficiaries. 80% of STRC is held in retail accounts. It's spreading virally. I mean, anybody that buys is telling their parents, their mother, their father, their sister, if you're a retiree and your choice is, I'm retired with $1 million, I either get paid $110,000 a year from STRC, or I get paid $20,000 a year from a money market. You can see why you might want this instrument. Corporations are buying it for their treasury in quantities $10, $20, $50 million or more. Stretch is the #3 holding in the BlackRock and the Van Eck preferred indexes. And this is, again, not even 12 months old, but it's already about 3 to 6% of those. A lot of ETFs are building on top of it right now, including Strive and 21. And I'll end with an observation that one of the interesting applications of this is you take digital capital, Bitcoin, then you create digital credit, and then you can pass that through to layer 3 and you create digital money or digital yield. Digital money is zero volatility, daily liquid instruments. Can I actually get to a stable $1 net asset value? And digital yield would be non-zero volatility, and maybe it's illiquid, but it generates a much bigger yield. You can program that money. You can create it in a token form or a public or private fund or an account. You can put it on a platform, a crypto exchange, a bank. You can program in the liquidity, the yield, and the currency you want. There are a lot of forms: a coin, a fund, and an account. But the general idea is you're starting with maybe 5 vol, 11% performance. You can step it down to get to zero vol and pay 7% or 8%. Or you can step it up, lever it with 4 or 5% money, and then you would be getting to 15 to 25% with maybe more vol. Who's doing it? A lot of crypto innovators are doing it. They're creating digital money and digital yield tokens. Most of these are all offshore because we don't have regulatory clarity in the United States. But if we do see tokenized securities in the US, you'll see a lot of these ideas pop up in the US. About $1.3 billion has flowed into the DeFi industry, into tokens and different types of structures that are being powered by digital credit. And so these are rapidly developing, and they'll probably keep growing. What's the risk of all this? It's kind of simple. The risk of digital credit is all based upon your view of the future of Bitcoin, right? This shouldn't come as a surprise. It's like you're buying a building in Manhattan. If you think that Manhattan is sinking underneath the ocean, the building is not a good credit risk. And so if your view of Bitcoin is as an investor, if you think it's as good as the S&P index, say it's going to go up 10% a year, and if you assume it'll stay as volatile as it is, then the credit risk on stretch is 97 basis points. That's the fair credit spread. So it looks investment grade. If you believe in Bitcoin is 10% to 30% growing, this is all investment grade. It's very simple. If you actually, and by the way, if we come back here, if you think that Bitcoin's going up 0% a year, it starts to look like high yield. And if you think that Bitcoin's going to fall 10% a year, it looks like distressed debt, right? It's not that complicated. And then you can calculate these matrices, and we have this model on our website for various collateral coverage levels and various Bitcoin prices. And what comes out is that over time, if Bitcoin is as good as any other capital asset, it's somewhere between investment grade or high yield, depending upon how collateralized it is. If you hate Bitcoin, you don't want to own any of it. And if you love Bitcoin, then it starts to look pretty compelling. The last point I'll make is this is a monthly dividend, but we're moving to make it twice a month, semi-monthly, and the shareholders are voting on that. That'll be resolved by next Monday or Tuesday, I guess. And the idea is to pay out 24 times a year instead of 12 times a year. We think that should decrease the volatility, should cut the volatility by some decent factor. It should increase the Sharpe ratio. It provides more entry and exit points. There's 24,000 companies that pay a quarterly dividend. 176 pay monthly. We'll be paying twice a month. And so that's it's an interesting thing. It all will start in June, kick in July. So let me just say a few words on the market right now. In the year 2026, there'll probably be $1 trillion of capital that's going to flow into AI and the hyperscalers. We can see it right now. In the last 3 months and the next 3 months, $400 billion of capital is being raised by OpenAI, by Anthropic, by Google, by SpaceX. You're literally watching an $85 billion IPO in SpaceX, an $80 billion offering by Google. No one ever dreamed that the company generating infinite cash, Google, is going to go to the market and ask for $80 billion more. Anthropic's doing an $80 billion raise. So what you have right now is a massive capital rotation, $400 billion in just a matter of weeks rolling into AI. About 1% of that, $4 billion has rolled out of the Bitcoin ETFs over the past 14 days. So you have a portion of capital. Clearly, people they're not financing the AI trade with all crypto assets, but 1 or 2% of the market is crypto. And there is a reallocation to get ready for these massive IPOs. That has created a downward pressure on the price of Bitcoin, which has fallen from 82,000 to 62, 63,000 over those 15 days. I think everybody, on X or in social media oftentimes loses their minds when the price falls, but it's not a complicated reason why this is happening. It's a massive vacuum. Every single investment bank on Wall Street is out there marketing the Anthropic deal, the OpenAI deal, the Google deal, the SpaceX deal, and everybody is got to come up with $400 billion of cash. And they're selling credit instruments, private credit, public credit. They're selling software as a service companies, anything that looks stable. You know, they're selling Bitcoin. They're rolling into the hot new issues, and that actually is the primary dynamic, I think, driving the market this week, this month, and it'll probably continue as long as these mega IPOs come. You know, in the history of the world, there's never been $80 billion IPOs, and we're getting like 1, 2, 3, 4, 5. This is going to be the biggest year of IPOs and equity issuance in our lifetime. How will the market react? You can see, I mean, there's just a massive amount of volatility. You know, sometimes things surging, sometimes they're crashing. I don't think any part of the market's immune to that. Okay, so with that, we've got about 10 minutes left. I'd be happy to take questions. I'll try to answer as quickly as possible.
Hi, Michael, to your right.
Yeah.
And for those that want to ask Michael a question, just please raise your hand and I will run over to you.
Hi, Michael. Carl Imigud from Minnesota Wealth Advisor. Keep hearing about quantum computing being a possible existential threat. Would love to get your take to see like what's being done about it, or if it is a big deal or not.
Well, I mean, all of the other existential threats, the Bitcoin we're taking off the table, everybody's got to have something to talk about. So quantum computer is the thing they like to talk about. There's no consensus that there is a quantum threat right now. There's a lot of enthusiasm about imagining one. Sometime 5 to 10 years out, there may be a quantum threat. When consensus forms that there is a quantum computer that can crack current cryptography, you'll see a wave of upgrades. Apple, Amazon, you know, every digital company, every bank, and all the crypto networks, including Bitcoin, they will all upgrade with post-quantum cryptographic libraries. There isn't consensus right now that there's a threat, because there isn't. I mean, there literally is not a quantum computer. What are we doing? Everybody in the community is looking at all different post-quantum upgrades. There's a security council of all the major Bitcoin holders and crypto holders that are cooperating on it. I'm pretty confident that at the point we need to upgrade, we will upgrade, but it's iatrogenic to upgrade before you actually have a threat, because if you force a premature upgrade, you introduce other threat vectors. The actual threats are more likely to come from AIs like the Anthropics and the OpenAIs hacking complicated new code to find a security breach. And so the most dangerous thing you can do is very rapidly add new production code that has not been thoroughly tested when the AIs are so smart at hacking it. So I say it's kind of like we imagine a disease that will kill us all in 40 years, and we have a vaccine that we can vaccinate our kids with right now, but the vaccine is 1% likely to hurt the kid. And so you think, well, maybe we'll just keep working on the vaccine and we'll study the thing, and when there is a defined threat, we'll take the vaccine, but not right now. Yeah.
Thanks. Anthony Dantali, New Orleans. My question is more tax related. You said that the yield is distributed as return of principal. How is that reported on 1099? It's just a non-dividend distribution? Do you have any idea?
It's a return of capital dividend, which means that you would, that the company makes the filings to certify that it's a return of capital, and we publish those on our 8Ks, and we publish them quarterly. You would reduce the basis of your instrument by the dividend you received. If you sell the instrument at a subsequent point in time and generate a capital gain, then you'll owe long or short-term capital gains when you sell it. If you don't sell it, then you'll just keep reducing your basis.
Okay, my question was more to the reporting to the client, though, but that's...
Well, I mean,
I
that would be a
theory behind
system-specific thing. I guess it depends upon what your platform is for, like which system you're using to manage your client's assets. I mean, I think that every broker-dealer, I mean, and every platform is a little bit different in that regard. I'm not an expert on how that works.
Hi, Michael. My name is Tim. I'm with Brown Miller Wealth Management here in Washington, D.C. and Virginia. I just want to hear your insights on what you think the future of stablecoin tokenization and modern financial systems will be, basically with the idea of T+0 and 23/5 or 24/7 for securities trading and other things. Just what's your oracle outlook on the future?
Well, I mean, the idea of stable coins is digital currency that moves at the speed of light, 24, 365, 7 days a week. You can move it 1,000,000 times a minute, right? Just friction-free money. There's consensus with the administration that this is a good idea. Right now, there's a little bit of political squabbling between the banking industry and the crypto industry about whether stable coins can pay yield. But I think that there's just broad-based consensus that they should exist as a medium of exchange. The friction and the guardrails or the limitations or constraints all come around how much AML, KYC, and reporting obligations, and how much functionality can you put into the stable coin. And that'll be resolved with, well, it'll be mostly resolved with the Clarity Act if it passes or it doesn't pass, and with guidance that comes out of Treasury and the OCC. I think that the regulators left to their own devices would be a little bit more progressive. The law itself will be probably a little bit less progressive because there are a lot more political interests involved. The more functional the stable coin is, the bigger the industry will get. It's gone from nothing to $350 billion right now. If the stable coins are very functional, it'll grow to trillions of dollars. What you notice, for example, is the more you cripple it, the more you constrain it, the smaller it'll get. But the market presumably is going to go to $1 trillion if it's constrained, and if it's less constrained, it could go to trillions of dollars.
One last question.
Hi, Michael. Bill Stack from Missouri. Question for you. The theme of this conference is talking about crypto and securities and navigating that world, and eventually, possibly people can buy crypto in their brokerage account. If that was to happen, is that a headwind to strategy and SRTRC, or is that rather a tailwind, because even if people go directly to buy the Bitcoin, it's going to help everything that you're doing?
Yeah, I mean, I think we see people like Schwab already rolling out crypto, and cities announced they want to allow people to buy the underlying asset. When you're buying the crypto asset, you're buying the commodity. When you buy the commodity, it's good for the people that hold the commodity. So I'd like nothing better than everybody to go buy Bitcoin, because we own a bunch of Bitcoin. It would drive up our assets, and it would be good for our stock and good for our credit as well. What I would say is if you want the asset with minimal counterparty risk and you just want the raw asset, you buy the digital asset, whatever it is. You might hold it with a custodian until you decide you want to take custody, but that's maximum optionality over the long term. If you're an equity investor, you're going to want to invest in equity. If you don't want to be troubled with the headache of holding the underlying commodity, you buy the ETF, like one of the Bitcoin ETFs like IBIT. And if you believe in the industry, but you don't want the volatility and you're afraid to take on 100% of the economic risk, then you might want to buy the credit. All of them are very complementary, and as banks embrace and build more functionality for all of these things, it's good for everybody. It all represents the digital transformation of the capital markets that should come progressively for the next 4 to 8 years, just quarter by quarter. Thank you. Appreciate it.
All right. Well, thank you, Michael. Fascinating stuff. Well, we're going to segue right into the more legal regulatory framework around crypto, Bitcoin, and all things of that sort. So it's going to be moderated by a good friend and primary counsel for TradePMR, Chaz Reiling. And the session is going to be at the crypto regulatory landscape that's still taking shape. So for advisors encountering digital assets through client portfolios, generational wealth or inheritance, The challenge isn't just understanding the rules, it's knowing how to act. So on the panel, we have Corey Garrison, Senior Director and Deputy General Counsel for Crypto at Robinhood, as well as Erica Crossland, Associate General Counsel and Head of Regulatory Enforcement and Investigations at Robinhood. So